Good morning and welcome to our Accounting Officer training. I'm Katherine Biscoe, a partner in Buzzacott's charity and not-for-profit team. Before we get started this morning, just a quick bit of virtual housekeeping. So as webinar attendees, your cameras and microphones are automatically off, but you will be able to communicate with us via the Q&A chat function on the right-hand side of your screens. All questions will be treated anonymously when we reach that part of the event. And the webinar is being recorded, and a copy of the recording and the slides will be shared with you by email after the event. So now turning to the agenda that we have on the slide, and for today's session I'm joined by Alison Pyle and Katherine Peacock, and over the next hour or so we will explain the key responsibilities of the accounting officer and provide some case studies from the sector to highlight some of the risks that you need to manage. As I said, there will be time for questions at the end, so please do add these via the chat function as we go, and we'll also follow up on any remaining questions after the event if we don't have time to cover everything. So I will now hand over to Alison for the first session.
Thank you, Katherine. So I'm going to set the scene and cover the governance of an academy trust, looking at the roles and responsibilities defined in the context of a trust and how the accounting officer fits into that. So on my first slide, I have the roles set out here. So we start with the members. They're akin to the shareholders of the company and they have the power to appoint and remove trustees. We then have the trustees, who are charity trustees and company directors, and the trustees fulfill three core functions. Firstly, ensuring the clarity of vision, ethos and strategic direction of the trust. Secondly, holding executive leaders to account for the educational performance. And finally, overseeing and ensuring effective financial performance. There's a lot of information in the Academy Trust Handbook about the trustees' roles and responsibilities, but that is a whole separate training course. So the trustee board must appoint a senior executive leader as the accounting officer. They may be a trustee, but that's not a requirement. In a single academy trust, the accounting officer should be the principal, and in a multi-academy trust, it should be the chief executive or similar. The individual must be a fit and suitable person for the role. They need to be employed by the trust, and the accounting officer role must not rotate. The trustee board also appoints a CFO, who is the trust's finance director, business manager or similar, to whom responsibility for the trust's detailed financial procedures is delegated. And finally, the trustee board also must appoint a governance professional, that is the clerk to the board, and they facilitate the effective functioning of the board. So moving on to my second slide, what are the accounting officer's responsibilities? There's a range of guidance and regulation pertaining to academy trusts. The key document for this course today is the ESFA's Academy Trust Handbook. This is updated annually. The most recent version is the Academy Trust Handbook 2022, which is effective from the 1st of September 2022 for the 22-23 financial and academic year. The accounting officer role includes specific responsibilities for financial matters. It includes a personal responsibility to Parliament and to the ESFA's accounting officer for the trust's financial resources. The accounting officer must be able to assure Parliament and the public of high standards of financial probity in the management of public funds, particularly regularity, propriety and value for money. The accounting officer must adhere to the 7 principles of public life. These are selflessness, integrity, objectivity, accountability, openness, honesty, and leadership. And the accounting officer must have oversight of financial transactions by firstly ensuring the Academy Trust's property and assets are under the trustee's control and that measures exist to prevent loss or misuse. Secondly, by ensuring that bank accounts, financial systems and financial records are operated by more than one person, i.e. segregation of duties. And finally, keeping full and accurate accounting records to support their annual accounts. Moving on to my next slide. Another responsibility of the accounting officer is the annual statement. So each year, the accounting officer must complete and sign a statement on regularity, propriety and compliance. This is included in the annual audited accounts and is submitted to the ESFA. This is audited as part of the external audit process, and we'll look at that in more detail in section 2 of this webinar. The accounting officer must also demonstrate how the trust has secured value for money via the governance statement in the audited accounts. The Academy's accounts direction, which is issued each year by the ESFA with guidance and model accounts, that includes further details about what is required from the value for money statement. The 22-23 Academy Accounts Direction was released recently, and this has clarified that both the value for money statement and the statement on regularity, propriety and compliance encompasses estates safety and management. So the Academy Accounts Direction suggests that accounting officers should consider demonstrating how they have effectively used relevant funding to ensure that the trust's estate is safe, well maintained and complies with relevant regulations. Apologies. They recommend that that's included as one of the value for money examples. Finally, the accounting officer has a duty to raise concerns. So the accounting officer must take personal responsibility, that cannot be delegated, for assuring the board that there is compliance with the funding agreement between the ESFA and the trust and compliance with the Academy Trust Handbook. The accounting officer must advise the board in writing if it is considering action that is incompatible with the articles, the funding agreement or the handbook. And similarly, the accounting officer must advise the board in writing if the board fails to act where it is required to by the funding agreement or the Academy Trust Handbook. Moving on to my next slide. So looking at that reporting in more detail, so more on those two statements that the accounting officer is required to produce annually. So the first, the statement on regularity, propriety and compliance, and the value for money statement. So what do those terms mean? The terms are defined in the HM Treasury publication Managing Public Money, and this is summarised in the Academy Accounts Direction. So firstly, regularity. That means that public money has been spent for the purpose intended by Parliament. Propriety. That means appropriate standards of conduct, behaviour and corporate governance have been maintained. And value for money, that is around efficient and effective use of resources. The HM Treasury publication details the tests that are detailed on my slide there, which might be useful for an accounting officer to consider whether a transaction is regular, proper and of benefit to the trust. So firstly, is the expenditure in the best interest of your organisation? Does the expenditure comply with approved procurement rules and policies? Will there be a valid business benefit to the organisation from the expenditure and not just a personal benefit to an employee? Is the expenditure necessary? And is the expenditure reasonable? Does it fully meet the identified and agreed needs? And has the expenditure been properly authorised? The format of the regularity, propriety and compliance statement is set out in the Academy Accounts Direction, Model Accounts, and that statement must report on any areas of non-compliance during the year, including the monetary amounts. So moving on to my next slide. How does an accounting officer form their conclusion? So the accounting officer must ensure that the trust is working within the boundaries of regularity and propriety. This work should be performed throughout the year as part of their oversight of internal control processes. The accounting officer will then need to determine if further work is necessary at the year end to reach their conclusion. And the Academy Trust Handbook says that this is not expected if proper internal control processes have been followed throughout the year. So what are those internal control processes? There are 13 areas that the Academy Trust Handbook identifies. Firstly, review of management reporting documents. So this is things like management accounts, budgets, risk register. The second area is review of trustees or governors' minutes. So this is to ensure that the board is carrying out its role effectively. And that ties back to the accounting officer's duty to raise concerns that we touched on earlier. We then have ensuring the use of funds is compliant with the funding agreement or relevant grant terms and conditions. So this includes the use of GAG funding and other restricted funds such as pupil premium, COVID funding, capital grants, etc. And the Academy Trust Handbook this year has clarified that that compliance encompasses estates, safety and management. So this means managing the school's estate strategically and maintaining the estate in a safe working condition and complying with the relevant regulations. The next area it covers is review of correspondence from the ESFA. So this would include things like notices to improve or minded to letters. We then have review of the school resource management self-assessment checklist. This checklist covers areas such as governance, strategy, the annual budget, staffing and value for money. We then have confirming compliance with the Academy Trust's scheme of delegation and compliance with delegated authorities. Part 5 of the Academy Trust Handbook sets out those delegated authorities and it details the areas that require prior ESFA approval, such as the acquisition or disposal of land, entering a property lease that is more than 7 years, entering any finance lease, writing off debts over 45,000, severance payments over 50,000, or indeed any novel or contentious transaction. The next area is evaluation of compliance with the musts in the handbook. There are a lot of must requirements in the handbook, and as accounting officer, it's important that you are aware of them. So I would recommend familiarising yourself with the Academy Trust Handbook. The next area is ensuring that related party transactions have been completed in accordance with the not-for-profit principles and that relevant statements of assurance have been obtained and reviewed. A statement of assurance is a certification from the supplier that the goods or services have been provided at cost, and that's required for any transaction above £2,500. And this also covers your processes for managing conflicts of interests, your register of interests and ensuring that that's published on the website, the reporting to the ESFA, and advance approval for transactions over £20,000. And it also encompasses your policy for gifts and hospitalities. And for multi-academy trusts, you need to consider that at a local governing body level as well. We then have consideration of whether any personal benefit has been derived from the trust's transactions by staff or connected individuals. Adherence to your tendering policies, so that's your procurement framework and your controls over processes, and consideration of the work and results of the internal scrutiny function. So this is your internal audit and the work that they've completed during the year. And finally, review of the tests that the reporting accountant, i.e. the external auditor, has carried out to provide evidence to support their own conclusion on regularity. And we'll look at that in more detail in the second part of this webinar. So those are the areas that the accounting officer should be assessing throughout the year. So moving on to my next slide, the practicalities. So in order for an accounting officer to effectively fulfill their role, that relationship with the trustees is really important. There must be clear lines of communication, and similarly the reporting to the Audit and Risk Committee. They need to work closely with the finance team, looking at areas such as delegation, the management accounts and the budgeting process, and it's ensuring that those systems and processes are sufficient and appropriate. And support from your external auditors. You can always refer queries or questions of interpretation to your external auditors. The accounting officer should be able to support their annual statement. While specific documentation is not specified in the guidance, the handbook does state that the accounting officer should maintain a file that details work undertaken throughout the year. It highlights that for two reasons. One is to provide support for the accounting officer's sign off at the year end, and secondly, to assist with the reporting accountant's questions. And that file is also going to be very useful where you have a change of accounting officer mid-year. So in conclusion, that's a summary of the role and a quick run through of the responsibilities of an accounting officer. I'm now going to hand over to my colleague Katherine, who'll look at financial statements and audit in more detail.
Thank you very much, Alison. So yes, I'll be looking at the financial statements of the Academy Trust and some of the audit requirements. So if we turn over onto my first slide, I think, yes, it is just worth spending a few minutes on the financial statements and understanding how they work and how the various sort of sections all fit in together. So as you've heard from Alison, Academy Trusts follow the requirements of the charity SORB FRS 102 in their accounts, but also the more detailed and more Academy specific guidance from the ESFA, which is issued in the accounts direction every year. And as we've heard, the latest version of the accounts direction for 22-23 has recently been published. The accounts direction also includes a set of model accounts for Copetown Academy Trust, which is quite useful to refer to as part of the year-end process. So the first section in the accounts is the report side of things, and the trustees report in particular, and that's where you sort of set out the activities and achievements of the trust in the year. So really your opportunity to highlight everything that has been done and achieved in the trust or the school and what difference has been made. And in some cases, even though not a requirement, you might start with a sort of a one-page introduction from the chair of trustees, which is a good way to get your achievements across at the start of the document before you sort of dive in to the more sort of regulatory disclosure requirements around governance, organizational structure, board committee meetings, risk management, and so on. So really given that flavour of achievements right at the beginning. The content of what you do need to include in the trustees report is provided by the charity's SORP, which is the framework that you are following as an Academy Trust. But as we said, the SFA does also provide more Academy sector specific guidance in their accounts direction. And the model accounts, the Coketown accounts, do include example of the required disclosures for the trustees report. However, I would say do make sure that you are considering that sort of template text, as it were, and making sure that you are adapting that to your individual trust's operations and requirements. The ESFA have picked up on this and have said that in some cases sort of standard text is used without it being tailored sufficiently to individual Academy trusts. From an audit perspective, when the auditors are looking at the trustees report, they'll be considering whether it's consistent with the figures in the financial statements, and also whether they think any sort of additional disclosure or context is required in order that those results are properly understood by readers of the accounts. As well as the trustees report, as you've heard and as Alison has picked up on, the ESFA has those required statements on governance and regularity, and she's picked up in particular on some of the key changes that are required around estates and safety and management this year. And then you have the trustees' responsibility statement. So this statement is underpinned by the board's responsibilities as directors of the Academy Trust for the purposes of the Companies Act. And then there are two audit reports, so on the financial statements and on regularity, and we will look at what these audit requirements mean in a bit more detail shortly. So then for the accounts themselves, these are comprised of the primary statements and the notes. There are three primary statements, which are the statement of financial activities. This covers the income and expenditure for the trust, the balance sheet, which is a snapshot of the assets and liabilities at the year end, and then the statement of cash flows, which reconciles the cash at the beginning and end of the year. And then all of the figures in these three primary statements are broken down in more detail in the notes to the accounts. So if we move on to my next slide, this shows the example statement of financial activities, or SOFA, from the Coketown Academy Trust model accounts for 22-23. And I think the key point to consider here when you're looking at a statement of financial activities is the columnar format. So as you can see, there are three columns for your unrestricted funds, the restricted general, and then the restricted fixed asset fund. And the different activities of the trust are sort of represented within these different columns. So if you're looking at a set of Academy accounts, you might really want to be focusing in on the result in the unrestricted or restricted general columns rather than the sort of overall result in the total column. And that's because that's distorted by the fixed asset element. So in this example here, you can see that the overall operating surplus for the year, so that's that surplus before any transfers between funds or any movements on the pension scheme, is that 54,000. However, if you sort of exclude the restricted fixed asset fund column, you will see, and that's quite, some quite chunky numbers in that column, 544,000 of income, which would be grants that you would have received to purchase fixed assets for the trust, and then 949,000 of expenditure. So that's your depreciation on your fixed assets in the year. If you exclude that column and those big numbers, then you actually come to a combined surplus on the ongoing activities, as it were, of the 123 plus 336, so 459,000 surplus for the year. And as you can see, this is quite different to the 54,000 in the total column. And why are these two columns more important? I suppose that's where the key operations and activities of the Academy Trust are flowing through. So in that restricted general column, you have your GAG funding, your pupil premium, any other sort of restricted grants. And then in your unrestricted funds column, that's where you would have any of those funds that are raised by the Academy. So fundraising, higher income, donations, anything that isn't restricted. So you can see quite different results if you exclude that restricted fixed asset column. If we move on to the next slide, this shows the bottom half of the statement of financial activities. So this is kind of below that operating surplus or deficit line. So the sort of more one-off movements that you might have in the year. So for example, transfers between funds. And in this case, you can see a transfer of £10,000 and that's moving out of restricted general funds into the fixed asset column. And that's where you may use, say, GAG funding to purchase fixed assets in the year. You would then have that transfer to tie up your restricted fixed asset fund to your fixed assets. You also, in this bottom half of the statement of financial activities, have the movements on the pension scheme, and this actuarial movements line represents that impact of the change in assumptions used by the actuaries to value the pension scheme. So things like future inflation, future pay awards, returns on assets, mortality rates, and all of these things, as you can imagine, are hard to predict, particularly in the current environment. So there tends to be quite a bit of movement and volatility in these assumptions, which means that the figure for the pension can vary quite significantly year to year. And you may recall actually that at the end of August 2022, the liabilities across the board did decrease quite significantly, and in some cases, some academy trusts may have had an asset instead of a liability. However, the point here is this is a long-term liability. So the theory is that over that long term, the deficit would be balanced out by increased contributions. And so it's not something that you need to consider as an immediate figure when you're assessing the financial viability of the trust. So in most cases, if you're trying to sort of understand the results of the Academy Trust, you would add that number back. If we then move on to the balance sheet on the next slide, this is a sort of a more straightforward statement. Really, it summarises the Academy Trust's assets and liabilities at the year end. So here on the top half, if we're looking at those assets and liabilities, key figures to sort of focus on are cash and net current assets, because these are really giving you the sort of financial viability or solvency of the Academy Trust. The fixed assets at the top, for example, is obviously mostly your school building. You can't dispose of that, so really you are focusing on those net current assets. And cash flow forecasting is obviously a key part of the activities and responsibilities of the CFO and the finance team. But as accounting officer, you will be responsible for overseeing that. So it is really important that is done throughout the year. As auditors at the year end, they will be looking at sort of concluding on the going concern assessment that will have been made by the Academy Trust. And to do that, they need to be looking at least 12 months ahead from when the accounts are approved. So as part of your audit each year, you will be asked as a minimum to have those cash flow forecasts through to the following December. And then on the bottom half of the balance sheet, you can see the analysis between funds. So this will tie through to the total columns on the statement of financial activities that we just saw. And again, some big numbers here, but the important ones to hone in on really are the unrestricted fund balance of 278,000. You can see, as well as your restricted income fund of 464,000. So even though that's restricted, it's the ESFA restrictions which just pertain really to the activities of the Academy Trust. So you can really look at those two in tandem. The total funds are distorted by some of those big figures. So the total fixed asset fund, as we said, represented by the estates, which you can't really dispose of on the whole, and also then the pension fund, which we talked about earlier. So really, if you're looking at the free reserves available to the school, it's that 464 plus 278,000. And I mean, what level of reserves should be held by an academy? Well, that's really going to be dependent on a number of factors, and it's something that really, as CFO and accounting officer and the trustees would need to consider very carefully. They need to look at that balance between, delivering education to students in the current year, but also ensuring that they do have sufficient funds for the future. There are some benchmarking guidelines available. A lot of people talk about maybe 1 month payroll as a minimum. There's now the sort of maximum of 20% of income, but actually considering what an appropriate reserves policy would be is a bit more complex than that, and probably a subject of a complete different training session. We do have a publication on reserves which sort of goes goes through some of the requirements and some of the ways you might think about it, which you might find useful. So we will also share that as a follow-up to the event. And then on my next slide, we have the sort of final primary statement. This is the statement of cash flows, and this reconciles your cash at the start of the year with the cash at the end. So here you can see that the Coketown example, Academy Trust, generated just under £500,000 from operational activities. You then have the 150,000 from investing activities. So this means the movements on fixed assets and the related funding. The note that supports that 150, note 26, isn't included in the slides, but if you take a look at Coketown, you will see that it relates to capital funding of 150,000 that was received in the year but won't be spent until the following year, and therefore is still sitting in cash rather than fixed assets. The financing activities line, you can see that's blank. This relates to loans, so in most cases this will be nil. So it will be rare to see this for academies because, of course, as Alison was saying, you do need that prior approval, and it's not normally granted. And we will then just move on to the audit requirements. So from both the external audit perspective, but also the internal assurance requirements, as Alison mentioned, both sitting within the responsibilities there of the accounting officer. So for the external audit, there is the financial statements audit opinion. So this is where auditors would need to state whether the accounts present a true and fair view of the performance of the Academy Trust in the year, of its financial position at the year end, whether they have been properly prepared in line with underlying reporting requirements, so Charity SORP FRS 102, relevant Companies Act legislation, they're compliant with the ESFA accounts direction, and also whether the information in the trustees report is consistent with the rest of the financial statements and the understanding that the auditors have obtained of the trust. There is a separate conclusion, limited assurance conclusion on the statement on regularity, propriety and compliance that is made by the accounting officer, and then also a limited assurance conclusion to the SFA on the compilation and contents of the annual return. So if we look at the financial statements audit first and what that would entail, what you can expect from the audit, in order to reach that opinion on the truth and fairness of the figures in the accounts, auditors would need to review each of the areas in detail, so they need to gain an understanding of where the figures in the main statements and the notes come from, so agreeing this through to your accounting system, other underlying records such as fixed asset register, payroll records, student records. For significant balances, there'd be analytical work carried out, so really the auditors would want to understand reasons for any variances from expectations. There'd be an element of detailed vouching and testing to support in invoices and other documentation as well. And it will be the riskier areas in the accounts that the auditors will focus on. So, for example, if looking at fixed assets, maybe if there was some capital work on the school ongoing over the summer holidays, which is how it tends to happen, then there might be an audit risk there around cut-off and how that's been accounted for. So auditors might be looking at invoices from contractors received shortly after the year end, for example. On the regularity audit requirements, so to provide that limited assurance on the accounting officer's statement, auditors basically will need to be looking at everything that you have done as accounting officer and that Alison was explaining earlier. So they will need to gain an understanding of the Academy's policies, systems and controls. They will need to review relevant transactions, so things like expenses, transactions with related parties. They will have to review supporting evidence, and this would include things like obtaining prior ESFA approval for such transactions where that is required. One of the ways that we do that at Buzzacott is to request the accounting officer complete a regularity self-assessment checklist, and that's a good starting point both to sort of document all of the thinking that you have to do as accounting officers prior to signing off the statement in the accounts, but also helps as a good starting point for the audit testing. And then finally, you have the internal scrutiny requirements. And again, you need to have that programme of internal scrutiny, which will provide that independent assurance to the board on the financial and non-financial controls and the risk management procedures, and that these are all operating effectively. There are a number of ways in which you may arrange to do this. So the trust handbook says you could employ an in-house internal auditor. You could use an internal buy-in an internal audit service from a firm. You could employ, you could use a sort of a non-employed trustee, or maybe even a peer review from another academy trust, but they would need to be independent from your trust, or indeed a mix of various of these options. However, what you can't do is use your external auditors to provide that internal audit service. There has to be complete separation there for independence reasons. So at that point, I will now hand over to Katherine, who will be looking at some more practical examples.
Thank you very much, Katherine. So for the next few minutes, I'd like to talk about some of the challenges for the accounting officer. And if I could have the next slide, please. This case study comes from an ESFA investigation a few years ago now, and it is one where pretty much everything that could have gone wrong with conflicts of interest and procurement did go wrong. So it's a good way to bring up a lot of different issues and examples. Where this started was from an ESFA tip-off. We don't know from whom, possibly a member of staff or a parent or anybody, who knows. But the key issues raised were a mixture of concerns around related party transactions, breaches of internal procedures, as well as a collection of internal controls issues. So starting with the catering contract, a decision had been made by the board to bring their catering in-house with supplies purchased from external companies. The issues that were raised by the ESFA was that there'd been no cost-benefit analysis done before this process, and also that the costs hadn't been compared to the previous catering arrangements. There was a tender process, but the contract was awarded to a firm who had a connection to one of the trustees of the Academy Trust, and that trustee did not resign from the board until after the tender process had been completed. The tendering process itself, there were some concerns raised from the ESFA review, as there was some internal evidence that the preferred supplier had had access to costing data from the previous catering arrangements, and also there was an internal presumption that I will be going with our preferred supplier. And when you're doing a tender process, it's very important to approach it with an open mind, without a preconceived conclusion about who you might be appointing. There was also a value for money perspective that by using a combination of some of the other suppliers who tendered for this particular contract, a lower cost outcome could have been achieved without compromising on quality. And finally, the procurement policy stated that any contract over £50,000, as Alison touched on earlier, needs to be approved by the Finance Committee, the Chief Executive and the Head Teacher in advance of entering into the contract. And it may have been improved internally, but there was no evidence that the processes had actually been followed and that this had been documented. So quite a few issues there on catering, ranging from independence of trustees through to following procurement policies and making sure that you document your decisions and the reasons for making those decisions. The next concern that was raised was around related parties and the related parties register not being up to date and not including all of the potential related parties. And I have to say, this is a really common audit finding that we see on quite a few occasions, that the trustees' conflict of interest register either isn't up to date or is incomplete. It's really important that all trustees do complete a declaration either annually or when they're appointed, and that this should include all of their directorships, trusteeships, and this isn't just for the trustee themselves. There's also a requirement for the trustees to disclose any directorships or trusteeships that their connected parties hold. So that's spouse or partner, children, siblings and parents. So potentially if people have lots of business interests, that can be quite a long list. And it's important to make sure that trustees understand that that does include their connected parties as well. The benefit of doing this is that then the finance team do have a complete list of all potential related parties. So if they're looking at appointing a new supplier, they've got a database of of potential connected parties to check against and make sure that they don't inadvertently enter into a contract with a related party. It's not impossible to do that, but there are a few processes that the board need to go through to make sure that the trustee concerned steps out of the meeting while the decision is being made and doesn't have any involvement in that particular procurement decision. One piece of advice I would give on this is if you're considering whether or not to do something and you would feel uncomfortable or embarrassed if it appeared on, let's say, the front page of the Sun, then maybe that's not such a good idea. Front page of the Sun test is always a good one. Moving on from related parties, but staying with procurement for the moment, we've talked about some of the issues tendering for a significant contract, but in this particular case study, the smaller contracts were just as important. The ESFA review identified a number of issues with consultants, and these included things like invoices that weren't dated, or work that had started before the consultant had formally been appointed and had a business engagement letter in place, and also invoices without details of the work undertaken. So it was very difficult for the Academy to be sure that they were actually getting value for money and the work that the consultants were doing had been appropriately approved in advance. So it's fine to use consultants if they're necessary, but there should always be approval of the business case and KPIs for the consultant, and then some evaluation of the work done. And as our quality control team often say, and I believe Ofsted do as well, if you haven't documented it, you haven't done it. So again, with all of these things, documentation is really important. This particular Academy Trust also had a purchasing card system with a limit of up to £500. And the intention behind this was to make it easier for travel and accommodation costs to be charged without the employees incurring significant expenses. And from the ESFA review, it was noted that not all transactions were supported by expense claims and receipts. And this is a really key control. If you do have purchasing cards or people use credit cards, it's really important to be able to demonstrate what the money was actually for, particularly if you have any hospitality costs, as in this case, the trust's policy was that hospitality could only be incurred if there were external people present at the meeting. So in that situation, it's very important to make sure that you can document that, yes, there was external representative from some other organisation present, therefore we incurred hospitality. As well as not keeping records of expenditure, these cards were being used for other things, potentially when they shouldn't have been. Things like gifts for staff who are leaving or gifts at the end of the year. And on occasions, these included alcohol, which is one of the specific prohibitions that no alcohol can be purchased by any Academy Trust for any reason whatsoever. So that gave some recommendations from the ESFA. And on one occasion, one of the cards was used to purchase a £50 gift card, which was again specifically against the Trust's internal anti-bribery policy. And if that wasn't enough issues on purchasing cards, there was also some evidence found that the cards being not used just by the allocated staff member, they were being passed around the team and different people were using them. So there were a few issues around the use of purchasing cards in this situation. So that is one to watch out for. If you do have a purchasing system like that, make sure the controls are in place to make sure it's operating as it's intended to, and that any issues are followed up. The ESFA also found some problems with travel policy. This was mainly around the chief executive using taxis around London when the policy stated that public transport should be used, and also hotel costs in excess of the policy limit. There is one thing I would say on that though, and that does actually raise the question about whether the policy needs review, because sometimes there can be a situation if you are trying to get between two meetings and it's tight timing, sometimes the only way to do that in central London is a taxi, and possibly also accommodation limits. The last couple of years, I think prices have increased, inflation has increased. if you are finding problems with accommodation being above your travel policy, maybe you need to look at the travel policy and check whether it remains appropriate. But leaving that aside, if you do have a policy in place, then it should be implemented. And finally, on this section of the ESFA's review, the review noted that a board meeting was held at a local 5-star hotel, even though the academy had meeting rooms on site that could have accommodated the numbers. It's not a problem having an external venue if it's necessary, but the academy should do an assessment of why you're using it and what the value for money issue is for using that venue. So those are a few things on procurement and travel policy. The final area for this case study is around recruitment. The review from the ESFA looked at 10 staff for the trust and identified that 5 of those staff had previously been known to the chief executive in their previous role. Now, that's not immediately an issue, but in this situation, for 4 of those roles, only 1 candidate was interviewed, and the remaining role, 2 candidates were interviewed, and the other 5, between 2 and 4 candidates, were present. The other thing the review noted was that not all files for those 10 staff had interview notes, evidence of references, or application forms. So it was very difficult for the trust to provide evidence that their recruitment process had been impartial and unbiased, and document that all adverts had been externally promoted. So it is important to make sure that if you are doing recruitment, that you can demonstrate you've got the best candidate and it's been a transparent and open process. So at the end of this review from the ESFA, the findings were that there had been clear breaches of both internal trust policies and also the financial handbook. Urgent action was needed to improve controls, and there was a long list of recommendations. I've actually not taken you through all of the issues ESFA came up with on this one, but I've highlighted the more common themes around process and transparency. So if I can have the next slide, please. Moving on to second case study. And this is a slightly different situation. This wasn't an ESFA investigation. This was the result of a journalist on the Sunday Times picking through published accounts for a small multi-academy trust and looking at the disclosed related party transactions. So not quite the front page of the Sun test here. We're talking about the front page of the Sunday Times. But the background was that the sponsoring entity and an individual trustee had incurred some quite significant costs before the academy was formed, which were then reimbursed from the Multi-Academy Trust, and it was disclosed in the financial statements in the first year of the trust. The academy had gone through the appropriate process. There was documentation, the minutes were there, although with 2020 hindsight, the board documentation could perhaps have been a bit more detailed, and the appropriate disclosure was made. But I think the thing I'd bring out here is that with related party transactions, public perception is also a factor. It's not just was the transaction appropriate, but would a reasonable observer consider the transaction to be appropriate? So there's a couple of learning points to bring out from this. Firstly, minimising the pre-formation costs, and if they are unavoidable, then they should be incurred by the sponsoring entity, not by an individual. And also, it's important to make sure that if there are going to be significant related party transactions, that the individuals concerned don't take part in the discussion, they step out of the board meeting while it's being discussed, and also that the documentation is absolutely watertight. Over the years, I've worked with a number of organisations where perhaps board meetings haven't been as detailed as they might be, and this is an example of why it's important. And then in a subsequent year, the same Academy Trust had a similar issue when the head teacher of one of the schools resigned, and the executive head then relocated to cover the role as well as their own job while a permanent head teacher was recruited. And the academy paid for some short-term rental costs for the executive head, which was absolutely correctly treated as a taxable benefit and disclosed in the financial statements. And it was reasonable and proportionate because they were relocating quite a considerable distance from their own home and also doing 2 jobs for the price of 1. So there was no issue around was it appropriate. But the problem is then when you have this disclosure in the accounts, it triggered more questions about related party transactions. So I think the key takeaway message here is if you do have something like that, put an explanatory sentence under the related party note explaining why it's happened and head off the question before anyone gets around to asking it. So those are just a couple of examples of the challenges that the accounting officer can face, and I hope it gives an indication of some of the possible solutions as well. We'll have an opportunity to discuss any questions, but in the meantime, hand back to Katherine for the Q&A session.
Thank you very much, Katherine. And I'm just looking at the list of questions, and we don't really have anything in the chat just yet. A couple of clarification questions really on whether we will be sharing the slides and the recording, and we will be sharing that after the event, and also that reserves publication that I alluded to. So don't worry, you will be getting that come through. I was going to wait a couple more minutes in case any further questions came through. But if not, do just get in touch with us after the event as well if there is anything that you think you would like us to cover next time. And other than that, thank you very much for attending. Thank you.